Hi, welcome to Market in a Minute. So we're in week number 2 of our tactical buy call. It's working out pretty well. So gotta say that was a nice move on our part, and we're in week 2 of it. The sentiment got too negative, so we got some charts on that to walk you through. And if you look out to 2026 earnings estimates, if we can get to that point where the market swings that direction, starts to look through the potential recession, and starts to discount those earnings, the market could actually have a really nice move. So, update on the tactical buy. So, we actually did our buy, our purchase, and it continued to follow from that point, but on March 12th, and we bought a number of different stocks as well, but we bought the NASDAQ, the Russell 2000, S&P type of exposure. And so we got much more invested. We don't have any hedges on, not for a while now. And we're benefiting from this nice move. We bought it on the 12th. And then on the 13th, the market went down. And then the 14th, we had a really big move in the overall market that day. So we missed the bottom by a day. You know, as what we pointed out on last week's Market in a Minute update, we're using that oscillator. So the oscillator got way overdone on an oversold condition finally, and it started to move back up. So on that bottoming process that occurred on March 12th, we stepped into it. So why did it happen? So you look at this bearish sentiment. So this is AAII investor sentiment. And so it got to as high as, actually the high was over 60% in terms of bears back in February. And the average is, there's 31%, long-term average is 31% bears and almost 38% bulls. So the bulls got down to less than 20% of the investors being bullish. So basically there was 3 times the number of bulls, or bears rather than bulls. So the market got too negative. So we were waiting for that oversold condition, to occur, plus a 10% decline in the overall markets. So we got the correction, and then on the 12th, and that's when we stepped in and started buying some things. So we've had a nice rally here, and we're picking off certain stocks as well. But what's interesting in the overall market at this point? We think the healthcare is still attractive. Financials, the retail stocks, retail stocks have been really beat up. There's some stocks 5 or 6 times earnings that are actually good companies. We mentioned Gap last week that we liked that a lot, and had a big move from that point. But Gap is turning, and we had a couple more we're going to talk about as well. And then the small cap area, energy's probably played out. The small cap area, that's our big play, I think later in the year or 2026. We want a really large position in that. We have a reasonable position now, but we want a really large position in the small cap stocks. And then the large cap tech stocks like Google, we like that one a lot. It's over discounting some negative sentiment. And then Amazon, we just turned positive on that. So we'll talk about that as well here. So if you look at the valuations of the overall market, you can see that it's now at 20 times. It got a little bit less than that, but 20 times 2025 earnings. I wouldn't call that reasonable, but if you take out the high valuations of the tech stocks, the overall market is reasonably valued. It's probably where it should be. The 490 stocks that aren't in those top 10, the average multiple is very reasonable currently, and kind of maybe nicely undervalued on 2026 earnings, given the level of the 10-year Treasury. So right now, the 10-year Treasury, where it is at roughly 4.3%, and the market at 20 times earnings, there's actually a risk premium in the overall market. So there's some value in equities versus bonds. So from the Federal Reserve meeting last week, we were surprised by the the runoff, them cutting the runoff rate of treasuries from 25 billion down to 5 billion. So that's going to be 240 billion less, 240 billion less in treasury runoffs for the next 12 months. So it's like them easing. It's like they cut interest rates a little bit. So we like that a lot. We thought that was very positive. They're not cutting the mortgage-backed securities runoff. They're going to continue to let those flow into the markets. There's currently a big spread between mortgage-backed securities and treasuries. We've talked about this in the past and why we're so positive about agency debt, which is guaranteed by the federal government. That's really attractive. We did take some profits in agency, AGNC. That's a mortgage REIT, and Dynex, DX, and a little bit in Annaly as well. Those stocks have moved up very nicely. Now they're all above their book values, and we're just taking some profits, not selling them, but taking some profits in those stocks. So what the market is struggling with is the tariffs. So you never know what's going to happen from one day to the next, right? When I wake up in the morning, I'm thinking, okay, what's this monster going to look like today, right? Well, we don't think the tariffs, in our mind, that the tariffs are a big issue. And what leads us to that is the tariffs have to be inflationary to be a big problem. Maybe it slows, GDP growth for a while, got that. But given the level of money supply growth currently, those tariffs, you're not going to monetize the increase in price of those tariffs. It may just be a one-time hit, or that may not be passed through at all, or very little of the tariffs being passed through. The other thing that's bothering the market is the government cuts. So we've been talking about this for a very long time, how Biden overspent. Now Trump is cutting back, what's being spent on a more secular basis, but also what Biden spent. So it's kind of a double hit. You got pulling back of what Biden did and then actually bringing down government spending at the same time. That could cause a technical recession, and I feel sorry for those people that may lose their jobs, but getting that waste and fraud out of the federal government and right-sizing the government for the long term or intermediate term as well, it's very positive. So we're not getting the bang for our buck out of government spending. It's not perpetuating economic growth. And if you privatize that spending, it will. So it's very positive longer term. The consumer slowing down, no doubt about it. We may have a negative quarter of GDP growth, so that is a problem. And then we'll see how long that lasts. And then the potential peaking of AI capital spending. Now, NVIDIA had their conference last week, and the CEO of NVIDIA changed his tune a little bit from talking about $1 trillion opportunity for AI spending to trillions of dollars of opportunity. I'm not buying that comment. If you look out over a very long period of time, maybe that's the case. But as an investor, I'm not seeing that as a possibility. You got these big four technology companies spending like crazy. My guess, it's flat to down next year. So that is a looming problem for the overall tech market. But we think NVIDIA actually might be reasonably valued if you're using the assumptions and have the mindset of the market itself. But in our mind, we don't find it attractive. So at 25 or 20 times earnings, we think we ultimately go down to maybe 17 times or where the current average is at about 17 times. So it's hard to say what's going to happen with those big cap tech stocks. But if you look out to next year, we're about 18 and a half times earnings now. So a little bit of a pullback could quickly get us to about 17 times next year's earnings. So a little bit more dip in the overall market, and we're about where we should be. I will say that with a preface that barring a really nasty recession, just a little technical recession, I think we have another 10% pullback. And so looking at the technicals. So here's what we did. We bought right around here, and the next day we fell. and that set up the bottom on Thursday as we discussed. And then we had a very nice pop, not even halfway back to where we were before. We're above the 200-day moving average. It's really good. 200-day moving average around 5750 on the S&P. That's an important level. Now, if we roll back below that 200-day moving average, we would probably get negative. Okay, so what led us there? At oversold condition, so the oscillator down really far. So if you don't use an oscillator, you should look at it. If you have a question about that, let me know. I'll ping you how to do that. And then we went above the 5-day, a very short-term moving average, right? Then above the 13-day. Now we're above the 20 and 200-day moving averages. My guess, completely a guess, because we're going to have fundamentals influence this a lot, that we go up around the 100-day moving average or 50-day moving average, and then probably break that back down below that. If the fundamental news is good, it won't happen. We'll continue on for a while. So I mentioned last week I was at the Roth conference, and something that's been overhanging the stock on Google, and something that we have an internal debate about is, okay, so the Federal Trade Commission won their suit against Google, and they want them to divest Chrome. Well, I don't really care. I mean, maybe it's a minor inconvenience, but I don't know if you ever got to get a new computer and you got Bing, okay, then you have to change it, or you can just have Bing go to Google search. So Google is the best search engine by far. The real issue is the search, the AI search. So AI, so at the conference there was a couple of these, few of these young guys that have these AI companies and talking about, their programs and the real opportunity is to get some of that search business from Google. And I just think that Google is going to protect that turf. Google has a reasonable search engine. It'll get better over time. Not seeing it in the Google numbers, not seeing their numbers really go down much in search, is kind of flatten out around that 10% growth. But they are so well positioned in everything. We like Google. They're positioned in all the hot spots of the technology sector. Quantum computing. So there was a company at the conference called Quantum Computing, and QUBT. So they have an interesting approach that they use light on their chips, and I can't come close to even describing how that works. But the chips are super fast, right? And catch this, no heat. So if you do your AI searches with quantum computing, if their approach kind of becomes industry standard or something like that, you're going to have much less heat and much less build out required to do AI. So we don't want to dissuade people from buying NVIDIA at this point. NVIDIA still trades at a very high multiple on sales, not on earnings, but on sales. And that's where our problem is we just believe that somebody's going to come into the overall market and come with a cheaper way of doing it. So you don't need Manhattan size, data centers to run this process. I've always believed in the downscaling of computer systems. It's going to always be the case. So that's the long-term issue with NVIDIA, that their approach is too expensive and requires too much energy. Someone's going to figure out a better way of doing it. In the meantime, the stock might be a really good bounce candidate from here. Apache and Bausch & Lomb. I love undervalued companies, high quality. Apache yields about 5%. They're going to grow we mentioned this last week, they're going to grow their cash flows at roughly 25% and then buy back a lot of stock as well. So their cash flow per share is going to look really good. It's nothing new for the oil sector of the market. A lot of these oil companies are doing this. but Apache really stands out. It's a really cheap stock. We like it. I like this company a lot. This is a 5-year sort of hold. Bausch and Lomb, they were spun out from their parent Bausch, and you think, okay, contact lenses and then droplets, that's not exciting, but they have a lot of new drugs, a lot of new products. So this thing's growing at 2 times the market itself. The top line is growing at 10+%. We like this one. It's a really undervalued stock. It looks really interesting. I'm going to find a place in our portfolios to put this. We don't own it right now, but I'm going to find a spot for it. Journey Medical. So the company's called Journey Medical, Derm. If you've been watching our videos, you probably know we've liked this a lot. It's probably up close to about 100% from where we really started pounding the table on it last year. And we own a fair amount of the stock, might be their largest shareholder. Had a good conversation with the CEO of the company. And the bottom line on this is that they got a best-in-class rosacea drug. Best-in-class, not by a little bit, but by far. And so the estimates for that the company's putting out there is about $200 million in revenues at peak, and peak may be only 3 years out. Then you put a 4 multiple on that, they may be pushing, they would kind of argue that maybe should be 5. But then you get a stock that has 6, 7, 8 times potential from where it is currently when someone will probably buy them out. We're thinking instead of $200 million in peak revenues, it's probably going to be double that. Now, the CEO is a bright person, and he wants to put out estimates that he can beat. So we think those estimates are too low, and there's a lot of upside in Derm. That stock's starting to really move. So as the market picks up on the movement of the stock, maybe some small cap portfolio managers will be coming down and buying that stock because it does have a lot of upside. It's good to be a specialist in biotech like we are. We find these great ideas. But other ideas, this is probably a really good pair trade to go long Amazon at this point and to go short Walmart. So we think Amazon, both companies are just great blue chip companies. They're dominators. They dominate the industry that they're in. Walmart has just performed incredibly over the last year. I mean, it had maybe a 70% 1-year return. Now it's pulled back quite a bit. Amazon has not. Amazon has underperformed by a lot. So the multiple on Amazon is less than 30 times. It is at a 10-year low. So we find the stock attractive. It's not the growth company it was because it's larger, right? But it's a blue chip stock at 30 times earnings. They've got that AI piece of their business that grows really fast and kicks off huge margins. And I think there's more that they can do in the distribution of goods. I'll say that before I say retailer. But Target trades at 11 times earnings. If you really want to compete with Walmart, maybe they don't. If you want to compete with Walmart, you'll pick up Target. Target is so cheap. I don't know what's wrong with Target. They had a good quarter. They talked a little bit negatively about their outlook because of tariffs, maybe because they're from Minnesota, have a more of a liberal view of the world. I don't know. Maybe that's the issue, but it really shouldn't deserve 11 multiple. And then Walmart is way up here at 32 times earnings. So I've rarely, just recently, have we had Walmart sell at a higher multiple than Amazon, and Amazon's going to grow much faster. So we've established a nice size position in Amazon. At this point, it's a trade, okay? It's a trade. We like the company a lot, but it's still on a secular basis, has a high valuation. We don't think that valuation comes down real soon, but it will over time. Thank you very much. Just remember, if you have any questions about what we do, come to my website, Patrick Adams CFA, and sign up for a hard copy of Market in a Minute. Give me a ping if you have questions. Just keep in mind, we are a tactical manager. What that means to us is we hate to lose money. We love making money. So when there's opportunities in the market, we're going to go for it. So this was a low risk trade that we had on this tactical buy. There's a lot of low risk stocks still in the markets, which makes us maybe a little bit more bullish than what the technicals actually imply. And then we focus a lot on biotech. We have a lot of expertise in biotech, and we've got really good numbers on biotech. So if you at all interested in any of the strategies we do, let me know, and we'll set up a conference call with you. Take care.